Welcome to Policy on Demand. I'm Julie Allen. As we continue to see developments on the legislative and guidance front, we've asked Jennifer Spang, our National Tax Accounting Leader, to join us and share some accounting insight with respect to those changes. Jennifer, welcome.
Thanks for having me.
Great to have you here. So let's start off with the Inflation Reduction Act. You know, many of the provisions included in the Inflation Reduction Act are effective starting in 2023. But the accounting treatment is evolving on a few of those positions, or on those provisions. Will you just let us know what companies should be thinking about?
There's really two big places to be thinking about. One deals with the minimum tax and one deals with credits. So for the minimum tax, the FASB believes that the guidance is not clear on how to think about a valuation allowance assessment of your existing deferred tax assets when you expect to be a minimum taxpayer. This is important, Julie, because when you have deferred taxes that are reversing and you're ultimately paying a minimum tax, really they're just reversing from one deferred tax asset, let's say, into another deferred tax asset, which is that carry forward for the minimum tax. So there's been this question as to how and whether you should think about a valuation allowance on your existing deferreds when those rules were enacted. So the FASB has concluded that there isn't specific guidance and therefore a company should make a policy choice. It'll be important to be thinking about that, at the time of enactment, but also to the extent your facts change as they go along, you'll need to continue to think about that. So companies can either anticipate their minimum tax status, if you will, in assessing deferred tax asset realizability, or they can choose not to and essentially just look at their deferred taxes without consideration of that. The other area that we've just recently had some updates on deals with the accounting treatment for the population of transferable credits that are in IRA. So we've had historically a fair bit of refundable credits. Those are generally accounted for outside of the tax line because they're really more akin to like a government grant or a government subsidy. In those cases, when you do not need any kind of taxable income in order to realize the benefit, to monetize, if you will, the credit, those should be accounted for above the line. Transferable credits are not that they've never existed, but they are definitely a newer area, particularly with IRA, at least in their magnitude. And what the FASB believes is that the most appropriate accounting is that a company should account for it on the tax line, regardless of whether they intend to keep the asset themselves and realize it, or whether they intend to sell the asset. Now, they do believe then any difference, let's say gain or loss, in this case, likely a loss when you sell it, should also be accounted for on the tax line. But the FASB did acknowledge that there isn't specific gap in this area, and therefore other alternatives might be appropriate or reasonable. The particular one would be maybe treating it by analogy to the refundable credits. So companies will have to think about what they're going to do and make sure they're doing transparent disclosure.
Boy, I think your points on both of those are really interesting about choosing a policy and then about the transferable credits and that they're new and that we always think about the tax side, but we also need to think about the accounting side.
Right.
Very insightful. Okay, so let's jump off of the Inflation Reduction Act and come to TCJA. So as you know, on TCJA, the capitalization of R&D costs under 174, that was introduced there, and that they introduced a delayed effective date. And I'm going to make sure I've got that right, that it came into effect for tax years beginning after December 31st, 2021. But it remains unclear to know if we'll see an extension on that. So what should we be thinking about an approach in this area?
It's a very common question, and I'd start with just saying GAAP requires that you account for a change in tax law in the period of enactment. So very technically, when 174 was enacted with TCJA, to the extent it would have had an impact, companies needed to think about that capitalization. Now, practically, for most companies, it wouldn't have had an impact. For those companies that had elected to consider guilty in their deferred tax accounting, it could have had an impact. And the other place in theory is valuation allowance. But as you moved into now this year, when it is effective, you've seen a lot more activity around that. So to the extent that there is, in fact, a deferral, to the extent that there is a change in tax law around that, companies will need to be prepared for accounting for that when that happens. So it's not something you anticipate And until then, you have to continue to account for it as, in fact, it exists today, which is capitalization. So we've seen a fair number of questions around valuation allowance assessments again, and in particular, the interplay with the capitalization in either utilization of credits or the impact, impact with the FDII. So we've seen some pretty interesting, results from the interplay of those items when we're looking at realizability.
Well, that interplay is interesting, but also the insight that you have on just watching that timing and watching on when you account for it when it's future. So that's very interesting. Okay, so now let's go to another hot topic that you have to know. We're going to ask you about this one is the uncertain tax positions, right? That the IRS recently announced their changes with respect to scheduled UTP. And so we've heard a lot from companies with respect to questions about this. And they've talked about when you look at that scheduled UTP in the financial accounting model, or I should say the financial reporting model, what are some of the things that they need to know about or that they need to think about in this area?
I think the most important thing is that a change to the form, well, we've heard a lot of people talking about potential behavioral changes. A change to the form has no impact on the accounting. The accounting hasn't changed. So GAAP provides for a two-step model, recognition and then measurement. And at the end of the day, that hasn't changed, nor would it because of any kind of required disclosure that might exist in the form. So I think companies need to continue to just do their accounting consistent with GAAP. You know, it is interesting to hear this debate because part of GAAP in the measurement of an uncertain tax position is this concept of cumulative probability. So it's interesting to me that that would be viewed as something that would be helpful from the government standpoint, just because it is a GAAP requirement that's not really based upon what a company expects to pay or anything along those lines. So again, it'll be another area to continue to watch, but the change in the form doesn't change GAAP.
And that's a key point in all these discussions that I've been in. We talked so much about the form, but your point of saying, hey, they are two separate items to consider. So great that you shared that insight and clarified that. Okay, we've gone through all three of those. Now, is there anything else when you think of other developments with FASB or anything that companies should have on their minds right now with respect to financial reporting, anything that you would highlight?
I think there are really two things. This is one is it's just the time of year, and that is around the valuation allowance assessments. But as you look at all of the activity this year, rising inflation, as you look at the activity around interest rates, we're seeing a lot of impacts on companies that don't typically have to consider an impact from a valuation allowance assessment, where some of that volatility is driving new questions for them. So can't stress it enough. And most importantly, it's not just a tax analysis. So when you're looking inside a company, it's important to make sure all of the right stakeholders are involved in that discussion. The other thing is just the most popular question I get, particularly now as we head into the year-end season, has to do with the FASB disclosure project. It's a project that's been going on for a number of years, but this year we had some revived activity. The FASB changed the scope, really focused on two disclosure areas, the disaggregation of cash taxes paid, and then also some incremental improvements to the rate rec. With that, there was at least a likelihood that there would be an exposure draft before the end of the calendar year. It's unclear whether that'll happen now. The FASB's doing their outreach. The next step would be another meeting with the board. But regardless of whether we see an exposure draft this year, two things to know. One, it is likely that one is coming and we'll see a new standard potentially next year. But importantly, that does not impact financial reporting in the current year that we're in. Nothing has changed yet.
And that's what everybody wants to know, what impacts this year.
That's right.
I think your point of tying the valuation throughout, I heard that a few times, tying that throughout is really key to keep your eye on. So thank you for sharing all of your insight. I think this is really helpful to weave that accounting income side into tax so that we see how important it is and how those interplay. So thank you for joining us and for shedding light on all of those areas. And thank you all for watching, and please join us next time.